Welcome to another edition of the Grey Market Talk with Thorsten, the former market maker, and Nic, the magnificent portfolio manager, chief investment officer, and the man who will explain us a lot today. We have a deep dive into liquidities, the tools for liquidity, and help us understand what's a Treasury General Account. How does that work with the repo facilities, with the reverse repo facilities? Where is this liquidity coming from, which is confusing me at the moment with the direction of the market taking? Nic will give us an insight into all of these things. And as an additional add-on, I have the beautiful position that I can ask totally stupid questions and pretend I know that already, and just asking for the benefit of my students who had, some of them, the pleasure to see Nic live already on various topics on the macro side. And we will open up a new playlist as well, which we call Deep Dives. And when I've asked Nic by chat message, hey, shall we call it a deep dive? I wrote a depth dive. If you don't speak German, it's actually a DE and a double P instead of the double D in deep dive. And a dep is an idiot. So I thought that was very, very appropriate for the questions I might ask today. I hope you will enjoy the deep dive we have at hand for you. And Nic, thank you very much for being my guest again and helping us navigating through, how did you call it?
Plumbing.
The plumbing of financial markets. Thank you so much. Good.
You're welcome.
Let me go right into the most important points. Let's start with how governments blow money out of the window. They have something which is called a general treasury account. Tell me more about that. What does that actually mean for a humble option market maker like me when we talk about a Treasury General Account?
Yes, Treasury General Account. That's their account with the Fed. It's the government's account with the Fed. Basically, it takes tax money in and then they can pay salaries out of it. They can pay benefits out of it. They can pay money to defense contractors out of this account. And obviously, this bank account, I mean, your and my sort of current account might be sort of fairly close to zero. Theirs at the moment is fairly close to zero. It was fairly close to zero during all of this debt ceiling discussion because they were running down their cash. They weren't allowed to borrow any money. So they were only spending. And then it got very, very close to zero. Then they made an agreement and now they're topping it up. You know, what are the implications of topping it up and how are they doing it? And, you know, that's something that the market is concerned about right now and actually is showing some effects on the liquidity situation, which we'll go through.
How can they top it up, actually? When we have a current account at home, we have two possibilities. Either I earn more, so I ask for a pay rise, which in government terms would be increased taxes to get more money through the door, or I use the overdraft facility. So as raising taxes is a very political enemy, which is not going to happen, well, at least short-term or in a massive proportion. What is their overdraft facility, Nic?
So what they would do is they would issue either T-bills or treasury bonds and into the market. And that stays in their account as a kind of an IOU because they never pay this thing back. And then they borrow the money from somewhere. And so their account gets credited by the Federal Reserve, who manage their account for them. So they issue money, they borrow it comes from somewhere in the market, let's just say, and then this account gets sort of credited with the money. And then what do they do with that money? They go and spend it. So effectively what's left in their account is the IOU, which continually builds up and is this debt which is forever growing. So that IOU doesn't sit with the Federal Reserve. That IOU is the Treasury's own kind of asset and liability, or really only liabilities.
What are the preferences or the limitations? You just mentioned treasury bills, so they're working at the front end of the curve. Are there limitations to say, oh yeah, let's issue a 100-year bond, or is this just preferences that are playing into these well, the way how they raise money through their credit facilities? Any idea about that?
Well, you know, imagine if you were doing this thing at the right time when interest rates are zero, you'd go and issue a 100-year bond. Yeah,
like Austria, like Argentina,
right, I mean, when interest rates were negative, you know, why didn't every European government just go out there and issue paper? And of course, now that interest rates are not negative, they're all running out there and saying, well, we need to borrow some money. So yeah, I mean, it depends on market conditions. You know, where is the interest rate right now? What do they want to achieve? And also, they are no doubt very sensitive to the fact that, well, if I borrow 10 years right now from the street, then effectively I'm going to be taking liquidity out of the market, and I don't want to do that. So I might want to entice some money out of, and we'll talk about that as well, the reverse repo account. And so I might issue T-bills today in order to do some topping up.
Yeah, before you start confusing me with the reverse repos and repos,
I know.
Let me dig in a little bit more. So what we have here now, the United States owes people who bought their papers 32 billion or above, trillion, sorry.
Trillion, yes, please.
You know, when we grew up, a billion was actually serious money.
Yes,
nowadays, when I was young, I wanted to become a millionaire. You know, now if you're a millionaire, it doesn't really matter that much. A trillionaire is, we haven't seen one yet, but a billionaire would be pretty cool. Huh?
Well, that just goes to show you, I mean, creating billionaires has been done because they're in debt and because they print money. And so, you know, they have devalued their currency over time because at the end of the day, everybody's doing it. And we let them do it because, you know, we let them do it because they have the power to do it.
Best measure of inflation, when I was young and my father sent me to the cigarette machine, we had those in Germany, to buy a pack of cigarettes. I remember I paid 2 Deutschmarks for a pack of cigarettes. Now I pay 8 euros for a pack of cigarettes. And, you know, I'm a little bit old, but not that old. So you actually see the real inflation we have creeping into all parts of. So we have the government, and the government wants to have a pot of gold. And by definition, like all Western governments, actually, they're always broke. All the money they take into through taxes are never enough. So they have to issue debt. And they do that by asking their prime banker, the Federal Reserve, and say, okay, we want to issue paper, you facilitate that, we end up with the money, and this money then gets put back into the business cycle because they give it to the guy on the street, and hopefully invest into infrastructure or something interesting it to increase productivity. So when they do this money then that they created by issuing paper goes to the government, and the government gives it to whom? In this whole scenario, I never had the government calling me and say, hey, Mr. Wegener, we just issued, could you spend it for us? So who is getting all the dosh?
Well, they won't call you. First, you're not American, but they might give it to Lockheed Martin, right? They'll give it to a defense contractor, or they might give it for you know, the Medicare or benefits, Social Security, or they might give it as part of, you know, the COVID support thing, where they actually sort of literally gave money to people so that they could eat, and that's what they do. So that money has effectively gone into the system somewhere to people, and people still have this money since COVID time, and therefore do not be surprised that inflation is higher than their target. And what the hell are they doing raising interest rates? It has nothing to do with the cause of inflation in the first place. I'll keep on about that because all I read in the press is, you know, so-and-so has to raise interest rates because inflation. But inflation was not caused by anything other than an explosion of money into the system, and the money's still sloshing around. It will get used up without raising interest rates.
Because when you and I were still sitting in the screens, the Troubled Asset Relief Program, which we had during the big financial crisis, that was exactly the point. So the government said, yeah, let's raise a lot of money because we have institutions and the whole world, the corporations to rescue. So this money ended up with the banks because they needed liquidity. It was pushed into the system like we've seen now with the 2020 crisis. Yeah, I'm not mentioning any names. Apparently, that's not good for algorithms to check you. So the 2020 crisis, everybody knows what that was. So it ended up a big chunk in the financial system. And what we then saw is interest rates. Obviously, the Fed was very active to reduce interest rates, going down to almost zero. Yeah? It was a lot of money. It was sitting with the banks, and then something strangely creeped in I think it was 2021, called the Reverse Repo Facility to stop. And that's how well, people are telling me that's why it was introduced. And you might correct me, I'm completely wrong. Stopping the market actually to produce negative interest rates, because the bank was sitting on piles of cash and they needed collateral for their cash, because cash is a liability. Yeah, to somebody gives you cash, you have cash in your accounts as liability, so you need assets. Where do you get these assets? You got these assets, my understanding, from the Federal Reserve. But where did the Federal Reserve get the assets from, Nic, if I'm right with that description?
Okay, I mean, your cash is asset, so that's actually a good thing, and all you want to do is to change the nature of your asset, because you say, well, what am I going to do with all of this cash? Because I can't really put it with that bank and that bank and that bank and that bank, because I don't really trust them, to be honest with you. So I'd like to sort of exchange my cash for collateral, or I'll go and buy something. Like, let me go and buy some T-bills. All right. So they all say, right, we're going to go and buy some T-bills. And so they go out all sort of in unison out there, and they say, right, we'd like to buy all the T-bills that are out there because we've just been given a shed load of cash and we want to buy some stuff instead. Unfortunately, what that does is, fact is, it would drop the yield down on these short-term instruments. And if the Fed is saying, well, actually, we want to keep the level of interest rates down, at 0 or 50 basis points or 1%, whatever it is they might choose, they need to incentivize you so that you don't go out and distort the market. Rather, they'll pay you 5 basis points more than the interest rate that they sort of state.
Let me quickly disperse something for my students. The relationship, or the inverse relationship between interest rates and prices of bonds. Yeah, because a lot of people have still trouble with that, especially when they start with financial market. What it simply means, it's demand and supply we have here. People are bidding up short-term papers. They want more and more and more. So the prices go up. Obviously, if the prices for bonds go up, they yield less. Yield is dropping. That is just what Nic explained, the relationship between interest rates and prices of bond assets. Sorry.
Yes, that's okay. So, at this stage, therefore, when when interest rates were, or when they were long of cash and looking for collateral, what they did was they basically said, okay, well, then I can't go and buy. It makes no sense to go and buy some T-bills, because they'll almost certainly yield less than what I could get if I went into the reverse repo market. And the reverse repo market effectively is a mechanism whereby they can exchange cash or collateral. And if people remember kind of the repo market from 2008 crisis time, it was the repo that was the problem for the likes of Lehman and whoever, because Lehman they needed cash.
Yeah,
right. So they needed cash. They said, guys, I've got some collateral over here. Are you interested? And everyone said, well, what kind of collateral you got? And they said, well, we've got some mortgage-backed thing. And everyone said, no. And of course, if you can't get hold of cash when you need it, because nobody wants your collateral or nobody trusts that collateral, or for whatever reason, they've only got one way to go, and that's bankruptcy.
So we had another action of that when the Fed, how long was that ago? 2 years ago, 3 years ago?
2019.
Yeah, 19 already. When the Fed was actually, as the lender of last resort, it's just the description you give here, actually realized that the repo market, which is usually between banks, one bank calls the other bank and said, hey, I need some cash, I'll give you some bonds for that, and I'll buy them back tomorrow, became dysfunctional. And that's when the Fed stepped in. Do I see that right?
Yes, and it became dysfunctional. It was exactly the same mechanism as the 2008 crisis, if you like, whereby people had collateral and they wanted cash. And the problem was that they had the banks at that stage had already run down their reserves. So they were already sort of fairly low. And because there was at the time, if I remember, something like large issuance of debt by the Treasury, plus there were some tax payment time, And so these guys are, well, actually, we need cash now. So we want to give our collateral. And they didn't really have the chance to do that. So the Fed stepped in and they said, okay, we will stand in for you and we will give you as much cash as you want. And that was the sort of solution to the 2019 repo crisis, as it were, so that the banks could collect all the cash that they needed. And, this thing had it was a blip and then it moved, the world moved on.
So in terms of liquidity, with repos, you provide liquidity to the banking system and therefore ultimately to the real economy behind it, under the assumption that banks then, if they have liquidity, are going to lend it out into the productive part of society, correct?
So, I mean, I wouldn't go so far, right? I would just simply say it's changing the nature of your asset. From you have cash, you want collateral. You have collateral, you want cash. And it's not necessarily that, because I want cash so that I can on-lend it to somebody. That's not always the case. And I wouldn't necessarily generalize, but I would simply say the banks manage their reserves and they do that efficiently. And the repo market is very efficient. They manage that. They say, okay, today I've got cash, tomorrow I've got collateral, and I keep switching backwards and forwards so that I make sure that I'm managing my my reserves, if you like, the way that keeps my bank sound and safe and so on.
So it's actually my original assumption. It's pretty much what Richard Koo defined as, we had that before in one of our talks, the balance sheet recession. Yeah, even though corporations can or have access to cheap money abundantly, they're not going to spend it. They're running down their own debt.
Yes, so that's an interesting sort of kind of distraction from all of this, but it's kind of relevant because in the period of time, post the global financial crisis, 2008 onwards, it was a shed load of QE. So, they were giving this like it was going out of style. Well, why wasn't, the obvious question is, why wasn't there any inflation then? Surely it's the same thing as what they did afterwards. Slightly different because now the government were also involved, but generally that is the right thing. And so what happened at the time, in post the global financial crisis, was that banks had no interest in lending money out, and they were actually downsizing their balance sheets because the regulator was on their back. They were this size and they had to get down to half the size. So what's the point of actually being given reserves by the central banks? They said, well, look, sorry, we're not lending right now. We are, reducing our lending. And that was what was going on post-global financial crisis. And that's why there was no inflation. And in, Japan, the story you sort of rightly say, the balance sheet repairing that was going on by the corporates. It doesn't matter if you put rates down to zero. If you don't want to borrow, you ain't going to borrow.
So it's a tool which works in theory as long as it's matching the appropriate stage in the business cycle.
Yeah, I mean, the timing has to be right. And obviously, the central bank has got it wrong in 2008 or before 2008. They were tightening credit before the crisis. And then, again, they missed the whole story. I mean, if you really look back at credibility, it's, they made an awful lot of mistakes, but, take it as it is. They tried to repair it rightly by throwing liquidity, because what else could they do? But the economy didn't have the chance to borrow money, because the banks were saying, I'm sorry, but we're just not ready to lend money. It's the same thing as, if you like, Silicon Valley case. Well, they didn't have the money, so they said, we can't lend you any money.
Hey, before I get on a rant here, because I know that they know the solution as good as you and I know the solution. Maybe a step back. A central bank, how does it attack inflation? There are two possibilities. You produce more stuff, or you destroy the economy. Yeah? You destroy demand in there. As central banks can't produce more stuff, we had this conversation about Liz Truss and Kwasi Kwarteng with their approach, let's get growth going. That will also be an insurance against inflation. If we keep the money supply stable and we have more goods, inflation will come down. I have this conversation over and over again, and I think I know why, or they all know how they could solve that. You remember the little city called West Berlin when we were younger, when I went to university? West Berlin was our now capital, Berlin, surrounded by communists in the GDR, which were still communists at the time, which was dominated by the Soviet Union. Why on earth would you want to live in an enclave like West Berlin at the time when you're surrounded by people who already cut you down from supplies with a Berlin airlift, which is in the history books, and who are shooting at people who wanted to leave their own country? By the way, there was one comment in the remarks when we had the topic GDR, and I mentioned the PDS, Partei des Demokratischen Sozialismus, and I was corrected that they're called now Die Linke. By the way, they're still the same party. They never changed their legal rhyme. They're still the SED, Sozialistische Einheitspartei Deutschland, which became the Partei des Demokratischen Sozialismus, and then did a rebranding to call themselves the Linke. So these guys are still the same guys who shot at innocent people when they want to leave the country. That just as a sidebar. So anyway, how could you then produce something as a government to tackle inflation, get growth going? The one thing they do not want to do, Berlin, West Berlin, everybody who moved to West Berlin paid 10.5% less taxes than in the rest of the German Federal Republic. That's how they got industry there. That's how they got people there, because out of their paycheck, they paid 10.5% less in taxes by going to Berlin. You have the same problem in the UK. You want to have the northern powerhouse. I think it would be so easy to get a northern powerhouse going. Yes, tell everybody who moves to Hull, you pay 10% less for your the industry or what you settle in, and you have the growth you want to have there. I think governments simply don't want to do that, because if they realize that people realize that could work, that taxes know a different direction as well, they might ask for more of the same in there. So we are stuck with the situation. The one thing that would work, they don't want to do. So they provide the market with liquidity, and now banks sit on this liquidity, and according or depending on the business cycle, they either lend it out or they don't, and they sit on it. So one of the tools we have, or the central banks and governments actually have to steer economy in the right direction, works more by pure chance where we are in there. So then we have one tool already there, which might help or might not help. This is the tool to say, yes, we get money into the economy. Where are we at the moment? Looking at the US business cycle, Nick, because then we can come to the other facility, which is in everybody's talk of the town at the moment. Corporations, do they have enough liquidity or don't they have enough liquidity? We have seen the, what was the Californian bank called? The Bank of Evil, Silicon Valley Bank. And obviously, they got screwed over because interest rates went up and their collateral wasn't worth what they thought it was worth. How's the American economy at the moment with 32 trillion in debt? And a US government, which is not really reducing taxes, what I was going on in a rant about a second ago. And we have inflation still at, especially on the core side or on the consumer side, at these high levels. What is necessary? What in the toolkit can they actually use to facilitate still a growing economy and justify why equity markets are against reality, what I always go on about, to what we see at the moment?
May I just do one rewind in the middle of your rant, so that I can just rant as well, and then we'll get an answer, I hope, to your question. But you know, this toolkit that you talk about, you know, they raise interest rates, you say, because, you know, there's one way to get people incentivized to produce, and that is to lower the tax. Or what is the other incentive to produce? To enable investment. And how do you enable investment? Cut interest rates, don't you? So just make it easier for people to invest and borrow money. So actually, oddly, in a period of inflation, you might think if the production or lack of supply of something was the issue, well, then you need to encourage investment. How do you encourage investment? You say, well, we'll make it cheaper for you, but they're doing exactly the opposite, because they have only one toolbox. they have only one button, and that is, at the end of the day, that is this this interest rate thing. They're causing suffering on thousands and million people, where they got mortgage or whatever it is, or some companies that actually are probably over borrowed for the state they were in, but thought, oh, well, I could suffer interest rates at 2%, but I can't suffer at 6% or 7%, whatever they're paying these days. So the problem is, and this comes down to what is inflation, what is it caused by, and this Milton Friedman, inflation is always and everywhere a monetary phenomenon, and monetary phenomenon is they basically chuck too much money into the system, and now they're saying, well, actually, it's not, it's a demand thing, so let's go and squeeze the demand. It's not the bloody problem, right? So they continue on about this, and I see this from the Europeans, I see it from the UK central bank, I see it from the States, and I actually see it from a lot of sensible economists who have been they've got this groupthink about interest rates. In my view, they're totally wrong, and I think the politicians better kind of figure it out soon, because if they want to get re-elected, they need to do something damn quick, and the thing they need to do is stop listening to their central bankers. Now, let's get on to the question of, are corporates in good shape? Well, when you look at corporate spreads right now, the corporate spreads don't really signal. If you look at the high yield spread has been sort of in a kind of 400 to 500 range in the last, kind of going nowhere. Yeah, but there are obviously companies here and there, and that's why you're probably seeing a lot more bankruptcies these days, is because when people start to borrow, and they do, let's just say they're sensible, they've got to show a business plan, they do a spreadsheet, they say, oh, my 5-year revenue is this, I'm going to borrow this money. Let's say interest rates go to 2%, from zero. Look, I should be able to afford this. And the bank manager says, oh, that kind of makes sense. And they sort of go with this thing. Then suddenly interest rates are 6-7% for the corporate. And these guys, not all of them can go through it. So therefore, you would expect, with the draconian policies of the central bank, which are punishing the wrong people, they should be punishing themselves, a lot of companies will suffer. But is it systemic? And I think systemic means, you would expect to see it in the market kind of sort of option adjusted spreads, credit spreads, high yield spreads. At the moment, you're not seeing that. So, coming on to the issue of, well, actually, they do have another tool, and it's called quantitative easing. But actually, they're not doing any quantitative easing, because they told the market, shoot, I can't do any quantitative easing now. I've got to get quantitative tightening. I've got to reduce the liquidity that my predecessors have pumped into the system in 2015 and 16 and whatever else, and in the time after COVID. So I've got to reduce my balance sheet. I've told everyone that, but are they? And
quick question: are you building me just the segue to get you on the reverse repo rate? Because that is the thing that goes through my mind. Yes, we told everybody we're taking money out of the system. Yes, we reduce the balance sheet we have in here, and then you hear about this 2 trillion. Shall I call it slush fund, which is on the reverse repo side, to still feed money into the market, or did I get that wrong?
You are slightly premature on that thought. Hold that thought, though. You might be right in 6 months' time. But what has happened effectively? I mean, there has been a number of things. Obviously, in the States we were talking about, right? So a number of banks had a lot of problems. So what did the Fed do? They initiated sort of a kind of an emergency borrowing thing, so that I know we have asked all of you guys to go and buy some treasuries. I know these things have fallen 10 or 15%, but we will assume they are worth 100 and not sort of 85 or 80 or whatever they're worth. We'll assume they're worth 100, and we'll lend you money on the basis that they're worth 100, so that you can restock your liquidity. So they've done a bit of that, right? That has kind of helped. They're still doing this quantitative tightening at the same time. So they're reducing liquidity. They've introduced a plan to add liquidity where is necessary in some banks that are, let's just say, struggling a little bit, and rightly they're struggling because of the business model that banks have got, which is borrowing from depositors, paying them next to nothing, and lending the money out into the economy. That's what they do. And that, you know, positive yield curve, that's how the bank works. But the yield curve's a bit inverted. The depositors have another choice where to put their money, earn 5% and not 1%. So the banks are struggling. But the other factor that, and it's still not this magical reverse repo account, that has happened in the last 6 months is, remember this TGA account that we talked about at the very, very beginning?
Yeah. Because
the Treasury were not allowed to borrow any money, the only thing they could do was to run down their current account. Yeah. So by running down this current account, the size of the TGA was, I think, close to $1 trillion, right? So $1 trillion has trickled in to the market without the market having to buy any new bonds from the government and so on and so forth. So over the last 6 months and more, when you actually look at the liquidity line, it's flat. So from May 2022 or thereabouts, right, something like that, when the market was sort of down, goes up and down again in September, the liquidity line was flat and actually then starting to increase. And it was not just sort of US liquidity that was increasing at the time. It was also, we had China reopening, China putting money into the system, and that also helps. But sticking with the US, we can look at that liquidity line and see that actually, because of this rundown of the TGA, this liquidity line has, and also the actions of the Fed during the Silicon Valley thing, that they've actually kept liquidity up.
So because somebody spent the money they had pocketed away for, let's call it a bad day, the government wasn't allowed to make, to borrow more money. So they simply used their checking account and pushed that into the market. And now we're at the situation where this checking account is empty, right?
Yes. And now they need to refill it. They won't refill it as much as this trillion. So the trillion was because I think they were expecting an infrastructure bill. So they were going to spend money into the economy, and Janet Yellen rightly says, okay, I need to prepare. So I'm going to gradually put some money aside, and she built this money up. And then actually they never used this money because this bill was never approved. So the money was kind of sitting there. They had drained the market of this 1.3 trillion, you know, at the time probably that the market could afford to give the liquidity. And then obviously that bought her time when there was this debt ceiling discussion because her bank account was really full.
So because that's one of the, I mentioned that before, I love to repeat myself, obviously. When I was a young trader, there is a guy called Dr. Jens Erhard. He's one of the finest German fund managers out there. You know him, obviously. Okay. And I was a young man. I've asked him at a conference. I said, Dr. Erhard, how do you know actually, what is your one overriding factor about equity markets? And he said, Mr. Wegener, just look at liquidity. If it goes from the bottom left to the top right on a chart, you can be long equity. You might make mistakes, be in the wrong sector, but you can be long. If this goes sideways or even never mind going down, you should not be in equities. That is the one overriding lesson you should have in here. And then if you go on the Fed website and look at liquidity and see, okay, what the Treasury drained. Then we have the Federal Reserve balance sheet going sideways, even going down at the moment. So these are two liquidity indicators, which are telling me at the moment, yeah, my fundamental thoughts about the markets are actually being supported also by the liquidity situation, at least from these 2 points we have in here. I get a little bit of an explanation now of your take on what they did with the Treasury General Account, that this money was already raised before and it simply pushed it into the market when the market was needing it. It wasn't spent on anything else. But in the situation we are now at the moment, there is no debt ceiling anymore. It's a misnomer. They haven't raised it. They simply said, well, we don't have one now until the next president comes in and he can sort the crap out, whatever happens. So they could go from 32 trillion to 35 trillion, 38 trillion. Who gives a toss? Obviously,
They
for political
will.
reasons, they can't really do that. So they are run down. They still have to pay bills. They're coming in. And the Fed says officially, no, we want to be good boys. We want to take liquidity out of the market because inflation is still a topic. What's next, Nic?
So you raised, firstly, this debt is going to 35 and 38. Well,
It could.
in those
Not
two
that it will,
steps.
but
It will go to 50 trillion, by 2033. That is accepted. That is forecast by the government themselves. They're not lying. They, this Congressional Budget Office issued twice a year a statement at February and May. We just had the May release to update the numbers, and it looks as bad, if not worse, than they estimated in February because interest rates are higher.
Are they buying everybody Teslas? Sorry, if you almost double this 32 trillion in a couple of years or in a decade, where's that all going? I know, yes, there are the social programs you have out there and there is infrastructure, but that also assumes you still live in a capitalist society where some of the infrastructure will be renewed by some savvy entrepreneurs to make money out of that. Where's all this dosh going?
Well, it is what you hire your president and your government for. They've got a list of things that they spend. So they say on healthcare, on benefits, on defense, which is probably going to be higher rather than lower. And now it wasn't in the list from the government. Now they're going to spend money on interest payments. And those interest payments are probably as large as the defense number. And I guarantee you that it won't be very long before the interest number becomes a political number, because it has to be paid. So when your tax receipts, we already said, were lower than your sort of outgoings every year, if you were an emerging market, you'd have the IMF lock you down, right? It's not an emerging market, but I don't want to say. So it's pretty damn close. So, but it's okay because they're allowed to print and they can continue to fund themselves. Now, in the old days, they funded themselves from, the Chinese, the Japanese, the Brits, the French, and, around the world, everyone was very happy to buy treasuries. Everyone wanted to be in the dollar. And it was a great place to park your money if you were long of dollars, because you exported, to America and everything was quoted in dollars. So let's just say, so everyone's got dollars, and in the old days they buy treasuries. They don't do that anymore. So the amount of foreign investment, I could show you a chart later, is now depleting. So there is only two places you could go. You could go to your pension funds and say, go buy my treasuries, please. Or not, please. Or you say to the Fed, oi, Jerome, this QT thing that you wanted to do, can you just change the T to an E and just carry on kind of supporting us? And lo and behold, if you look at the Congressional Budget Office, from 2026 or thereabouts, Congressional Budget Office assume that the Fed will continue QE. Jerome hasn't said anything, but the CBO, they basically said, because it's not feasible to fund ourselves. So this, slow kind of buildup of, or it's actually an increasing buildup of debt in the States is really where the problem lies. And I said it before, it's the debt has gone from the banks in 2008 and everyone else up to the sovereign. Now the sovereign's got a real problem, and it sort of created that problem really with all the money it created and for the COVID thing and stuff like this. Once you give the money out, you can't get it back. Nobody's going to say, I pay you back.
It fits very nice in with your baseline thesis you're trying to explain to me now for weeks, that actually, if it becomes one of the big issues, the interest rate or the interest rates on the debt in the United States, what cannot happen must not happen.
Yeah, exactly.
Okay, I start getting it now. So yes, we're blowing out, obviously, the debt in the United States up to 50 billion in a short 12 years, trillion. It used to be a lot of money, not anymore.
10 years.
To 50 trillion. And the Fed still wants to face safe to fight inflation. And in my book on the markets, that's simply, I want to short the crap out of NVIDIA because they are being valued with 40 times revenues. How does that
I'm
make
not sure
sense?
how you link the two, but I do get where you
I always find a link.
Yes, well, you're doing the same thing as the view on treasuries. You're saying, but that's ridiculous. Surely something's going to break, so therefore I just sell stuff, right? And then you look around and you say, what is a stupid, valuation? And you come to NVIDIA and say, well, that's a pretty stupid valuation. That's a good thing to sell as well. That's a different. We can talk about timing in another thing.
Well, surely if interest rates must explode at one day, in my assumption, because nobody wants that money anymore, then you want to be short the longest duration asset out there. NVIDIA for me at the moment.
But if you believe that, I understand where you're coming from there, but if you believe that the Fed or central banks in general are forced to pump liquidity into the system, then you want the longest duration asset on your books.
Well, that's your theory, yes.
And NVIDIA, but nobody is going to sort of be around when NVIDIA sort of, you know what I mean? I mean, AI is a big thing. We have no idea about, how to value an AI company clearly. This valuation might be as wrong as something that is, at 20 times sales or at 10 times sales or at 5 times sales. It's just don't know.
So let me force you back to the original question. So we have these 2 points. The Fed wants to do something, but has their hands somehow tied. The government is broke, and the government has to refill their general treasury account. How are they going to do that in the scenario we're in right now, Nic?
So that's really the question. So now comes the bit where we talk about your favorite account, which is the reverse repo account.
Oh, I just love to say it because it's something new I've learned. I have to throw it in wherever I can. I've seen that many times with my students. They learn something new and then they repeat it all over. I'm the same situation right now because for the first time I looked into, you called it right at the beginning, the plumbing of the system, and it looks ugly.
Yeah, it's complex actually, but it's complex. But in the end, the Fed created something to fit the problem that they've had. But of course, like anything, once you sort of add more cables and pipes and whatever, sooner or later you realize that it doesn't work, and it doesn't work right now. Really, you can see that with SVB and these other banks. It doesn't work when you take interest rates from 0 to 5%, having 12 months before said, lower for longer. And then, 12 months later, you pull the rug, and that doesn't, something's going to break, right? It's clear. But, this is a deep dive into the liquidity thing. So, do you get now how these 3 accounts kind of fit together?
Yeah.
There was a question on how to calculate this stuff.
Well, let me feed you with the numbers. I'm reading the papers at the moment all the time. So the government is pretty much broke on their account. They need about 500 billion to pay the salaries of the government employees, and they would like to have a nice cushion of another 500 billion in there. So we're at $1 trillion. The general treasury account needs the refill. Then we have the reverse repo account at the Fed, which sits on roughly 2 trillion.
Yes.
Right? But these 2 trillion will have an impact on liquidity in the market. What is happening now in this, and that's where we actually are closing this circle now, which I'm trying to get my head around. What's the impact of the reverse repo facilities, the general treasury account, and what happens after that to liquidity in the market?
So if they issue bonds, then they are likely to drain liquidity from the market. So they are trying to tap something which has already drained that liquidity. The thing that drained that liquidity was this reverse repo account. So by issuing T-bills, very short-dated treasury paper, they are able to kind of incentivize these funds, these money market funds that play very well in the reverse repo account. So reverse repo, who's it available to? Firstly, it's available to banks, it's available to funds, money market funds, it's available to, I think, sort of government-sponsored entities. So these are the kind of the people playing, and the biggest players I would say are probably the money market funds, but somebody who's almost certainly going to correct me there. So they are incentivized right now to do a reverse repo with their cash. Now they have the opportunity, because Janet Yellen is saying to them, well, look, have a look at this nice, shiny T-bill, and it will pay you X, and it will lock you in for 3 months. You don't have to write a ticket every day and every week and whatever. So how about having some of this? And let's just say they are sufficiently incentivized to move from a reverse repo into a T-bill. And sometimes it's just a phone call from somebody senior to say, do it. Then that would be liquidity totally neutral on the market. So the market liquidity will remain flat whilst the TGA is going up and the reverse repo is going down. Because
the Fed would do that by taking the 5 basis points on the reverse repo facilities away.
And well, they're not going to do that. They won't do that because they don't want to. They created that 5 basis points, after deep thought and, what it was for. They still want to have control over interest rates. So they, technically they could just put the reverse repo level down from 5% down to 1%, right? All right. But the problem in doing that is obviously then you're back to the first explanation you gave, and that was, well, then the interest rates will no longer reflect what the central bank is setting. So that's why they created this thing in the first place. So they probably still keep the level there. As I say, there has to be a reason to do this thing. And sometimes it's a phone call. Sometimes it's convenient. Sometimes it just fits their books that they don't have enough T-bills. And they say, okay, well, we didn't have enough T-bills because the Fed wasn't, the Treasury wasn't issuing them. We prefer to have much more T-bills and reverse repos. It's fine. We'll take these things because that's collateral as well, because I can use T-bills for collateral in what I'm doing. So for the banks, it might make an awful lot more sense for them to take T-bills rather than reverse repos. But anyway, but the formula, coming back to what is this liquidity and how do you calculate it? So broadly, we have the balance sheet of the central bank is the main number. But from that number, they have 2 accounts on their liability side, which are claims on those assets, if you like, that detract from liquidity. So if you mean the liquidity is the assets of the central bank, but what take away the liquidity is the size of the Treasury General Account and the reverse repo account. So the basic formula is central bank assets less those 2 accounts. Slightly complicated because the central bank is losing money right now, and therefore that is also detracting from liquidity because that money just goes to the back to the Treasury.
So does it mean simple folks like I got it all wrong in the understanding to say, fine, the government needs money, but there is a secret pot of gold where there is twice as much the amount of money already in there to make this drainage, which you would expect if the government is issuing new treasuries and sucking liquidity out of the market. We have the reserve repo facility. There are 2 trillion in there. The government needs roughly 1 trillion now, so there's no worry about liquidity drainage. And the Federal Reserve Bank can still say, "Oh, we're fighting inflation. We're all good. We're reducing our balance sheet slightly."
Broadly, everything you said is correct, but you must ask a fundamental question. Why does Janet Yellen care about the level of liquidity in the system? And, what does this thing do for, she wants the money. She says, okay, I'll go and do some 10-year notes, Why do I care if there's no liquidity?
I could assume it's the Bear Stearns moment again. We have seen Bear Stearns with the Silicon Valley Bank. And now we have the phase of quietness in between before the big blow up with Lehman happened. That could be an explanation for
Absolutely. Me. Those are 2 top reasons, and that's exactly the issue, because the Treasury market is the most important thing it's the collateral of treasuries is used for borrowing and lending, right? Yep. So if you screw up that market by it, suddenly it's, saying we don't care about liquidity, mate, and this thing goes, suddenly the haircuts people will require will sort of go haywire. Yep. And then you have that Lehman moment for somebody, then you have that SVB moment for somebody. And that's a real problem. So clearly, rightly, Janet Yellen says, no, we have to sort of do this in a measured way, sensibly. And so I guess they are, doing that. Yeah, I mean, she's fairly experienced at this kind of stuff. So she is doing what she can. But what I noticed and I mentioned it last week's call, that the liquidity kind of calculation is, the market has gone slightly a bit too high versus where liquidity is today. Mm-hmm. So it was vulnerable to some kind of profit taking, some kind of sell-off. These elastic bands you can stretch for, a little bit, but not too much sometimes. So, and it could be, whilst they are juggling with this trillion that you rightly say, maybe a little bit slips here and they can't quite get the money from the right spot, and liquidity declines. Could be temporarily, or it could be something that causes a bit more of a hiccup. But as you saw with the Bank of England in the September quasi thing, the Chancellor story, the Bank of England to the rescue. At the moment that the gilt market fell apart, fallen apart, they came to the rescue, and I suspect the Fed will do the same.
Well, with the gilts, I was speaking to a lot of family and friends in the UK at the moment, especially on the mortgage side. Have they actually noticed that it's a big impact if you used to pay, let's say, $500 a month for your mortgage payment, and that now goes up to $1,500 or $2,000, that has a real massive impact on the UK economy?
What I said last week to you was that I guarantee you, I don't know if I use the word guarantee, but I'm pretty damn sure that the government will not allow repossessions for being late. Yeah. The next day, the Prime Minister and the Chancellor, I think, both said, well, we're not going to help them. And I thought, I don't believe that. And then I think a few days later, they agreed that they would give people 1 year grace period before any bank can try and, repossess somebody's home. And I guarantee you that, I'm pretty damn certain that they will also extend that. But the damage to what I call innocent people for this interest rate rise, is totally unnecessary. And, the government needs to take control of this situation. It's all very well having an independent central bank, but if they are cocking things up one after the other, then I think you do need to act.
So what Janet Yellen and Mr. Powell are doing at the moment, they're actually doing, when I take all I got out of our conversation today, they're doing a quite measured, good job, actually, of managing liquidity and expectation in the market, while at the same time keeping powder dry for those moments where it could get unpleasant. Or am I now on the wrong track? Is it too positive?
You're good. I think it's giving them probably a bit too much credibility, but let's just say their behavior is much better than what the B of E is doing, because I think the B of E are taking from the left and taking from the right, and I really don't think they know what they're doing. Whereas the US authorities are, they're taken from the left, but maintaining stability of the crucial market for them, which is the Treasury market, and therefore keeping the liquidity and the stock market, which we explained before, was a very, very important driver for tax receipts in the States.
Yeah. Well, let's put it that way. People always call the stock market as a leading indicator. Now, for the first time, taking this deep dive into liquidity, it actually makes sense that we are where we are at the moment. The market is shaky. There are a lot of external shocks which could obviously hit this very, I always want to call it price to perfection market almost. We've seen a little bit of, don't call it perfection, but of a soundly managed liquidity system at the moment in the United States. which facilitates for the point where we are at the moment. One thing that always, because we also touched the topic of Japan in our last talk or the talk before, and I spoke about it in my German podcast this week about it again. They had pretty much this scenario in the late 80s, 90s, right? Then the central banks moved in, they made money cheap, people didn't want to spend their money. Could we come in, because that's one of the topics I hear all the time as well, could we move into a lost decade for the United States, where actually markets are not doing anything?
You know, the geopolitical situation is so complex right now that the US could quite easily make it or break it on the basis of what their currency is going to do. And I've just read a research report which suggests that. So when the dollar collapsed in 1985, actually, and then we had the stock market crash in 87 and so on. So when it was clear there was this accord from Baker was the US minister, and he agreed that the dollar was going to go down and the yen was going to strengthen and so on and so forth. And what did that cause? That actually caused a disaster for the Japanese economy by having a strong currency for kind of too long at the end of the day. So currencies will play a bigger role in terms of lost decades, and we just have to see where that goes. But for the rest of mankind, you know, it could also be a lost decade when you kind of wake up, you think you've got your money invested somewhere, it's earning a couple of % here, or what, you know, you own some stocks, you own some bonds, and then you try and spend it. And the thing you want to spend on is actually sort of shot up in value. You've kind of totally missed that. And then you say, well, what am I supposed to do in my retirement? And, you know, these are the critical issues that I think are relevant to people. And whoever I talk to, I mean, I say, you know, I don't know what the right number is to have some, you know, kind of debasement hedge, whether it is gold or Bitcoin. For everybody is going to be a different number. But you need to think about, you know, the kind of the defense play to protect you from what, for me, is the obvious, and that is a continued debasement in currencies going forward. And then all these currencies will all do their thing together. But when you look out the box and you realize, actually, I want to go and buy some stuff, you haven't got any money because everything else is shot up in price, whether that's commodities or whatever, right? Don't know.
Maybe as a final word, I can put that in, because you were long crypto off air and just told me about it. You seem to picked it at the right place and time, and now I can also put #crypto into the discussion box, because what I have noticed is crypto people like to comment, and that was my question to all the listeners and viewers we had today. If you don't mind, give us a like. We like that. We want to entice the algorithms to share this content a little bit more. Comment in the questions, because this conversation we have today was one of the comments we had on our last talk. One of our viewers was talking about liquidity and that we should actually talk more about it, and that would fill a whole show, which it did today, without any doubt. We didn't talk anything about Russia or politics in there. We really went into the details, and I want to take the opportunity to thank you, Nic. You really gave me a great explainer about the plumbing, which is a fantastic word, of financial markets and liquidity. And I hope that all my students will get the most out of this conversation. And everybody who is not my student will probably also find a new way of making sense out of what we are seeing at the moment. I started thinking down these lines you explained to me today, that actually there are more variables in there who interact with each other than I thought they would. So going a little bit underneath the surface helped me a lot. I thank you for that. And I think we should have far more deep dives into these really nitty-gritty topics in the future.
You really are stretching my knowledge base, but it's okay.
Hey, you're a fantastic teacher. Thank you so much for it. So let me use, let me give you the final word. You can say the goodbye, and then I do the outro.
Okay, I'm just going to say 2 words: Seiko Epson, which was a question in, you know, on which company does the goggles, and that came from a research company Pelham Smithers presentation. So do your own research, but I want to answer questions that come through on video. And thanks very much.
Excellent. Thank you very much, Nic. Thank you very much for watching us. I will put that on the screen as well. As we're finishing off now, the after party, which could take another 1 or 2 hours, I'll have a couple of more unrelated questions to this topic. Thank you very much, Nic. Thank you very much for watching us. Like us, subscribe, and share the video. Thanks. Goodbye. See you next week.
Thank you. Bye-bye.